Predicting a crash is never easy. Some economists use moving averages. Others look at fundamentals only. Some look at cycles. These cycles can be any length of time, upwards of hundreds of years. When patterns form, people and algorithms take notice. You came here for the truth. Let's look at a few charts today, and one in particular is the 6-month cycle which has formed in the S&P. Let's begin right away with that very chart. This is telling. This is very clear. And I want to show you this and then lead into a few more. But this here, a 6-month cycle which has begun at the end of 2014. And I would say that this is enough 6-month patterns here to clearly determine that yes, in fact, this is a pattern. All right. Now, what we have in previous instances, as you could see these declines, some of them more steep than others. For example, this one here being more steep than this one here. And the general trend since, 2016 or so has been up. That's clear. Okay, let's just tell it how it is. However, there is this question mark at the end, and it seems to be, if this 6-month cycle is to continue, that the trend is downward. I didn't make this up. I didn't suggest it. I'm showing you the patterns which have formed historically. You make the decision for yourself. What I would also note from here, and this chart doesn't go back far enough, but there was a big stagnation for quite some time after QE3 had ended of just, up and down, but basically flatlining on the stock markets for that long period of time. And it wasn't until more recent times where we did see a rise in the stock market. So that's something that I also wanted to note. I think that's important because people are, considering that yes, the stock market has gone up, but it was at a standstill for the longest period of time. And think about all the inflation that was added during that time and everything. Nobody really takes that into as a factor. All right, next. Looking at the market since 2016, and we're taking 3 basic indicators, with the dollar, the gold, and the S&P 500. Okay, it's good to look at a few basic things all the time, keep up with it, but once a month or so you should measure these and just see where things are. Things change over time, as you can see, but it's good to just continuously monitor it. I try to give you that on the channel, but if I don't, then you should be doing that on your own. Okay, let's look at this quickly. So right here, we're essentially talking about the end of December, okay? Since that point, we have had a little bit of a rally in gold, and you can see where it has ended up in more recent times. The S&P, obviously, which has been the best performer, it seems, slow and steady rising during this time. And then you have the dollar, which in the past few months has actually taken a little dip there. I don't really have an opinion on this chart in particular. I just wanted to show you what has happened. When you compare this to emerging markets, you get a different picture and everything, but I just wanted to show you these 3 markets right here, where in this period of time, you have seen gold, the dollar, and the S&P 500 all come up. It's interesting anyway. This is just another example of computer algorithms. U.S. House Freedom Caucus Chairman Meadows. There are still not enough votes to pass the healthcare bill. And you see this massive straight down line, okay? And when you look at the actual value that it declined. I mean, it doesn't necessarily mean that that's, a huge jump, but the volume is intense at this time. And also you're looking at the speed of that decline. Now see, on the way up, it seems to have a little bit more of a steadier rise. On the way down, it just drops off. These are computer algorithms, okay? That's just the way this is. Whenever you see it drop off in a straight line, you know it's a computer algorithm. That's just the way it is. So look for those as things go on. When news comes out, you see the different markets, whatever they might be, and look at them. Look at those charts. Look how they are affected. All right, moving on. The S&P 500 versus, basically this is earnings, okay? S&P 500 versus the earnings. Lo and behold, the tech.com boom. We are now at the same level that we were back then. Comparing this to the financial crisis, what happened? Well, you had not even close in this regard having this crash take place, okay? What can we expect? Well, in the previous instance, .com boom, we saw this particular ratio declining significantly after. Whether or not that'll be the case, again, I don't know. All I know is that we are record highs for this. It's never a good thing to go and bust beyond this type of record. You don't necessarily want that. That's not a good thing. And this here is another price earnings type ratio where in this case, we are only second to be the top right now. That would be the dot-com boom and the Great Depression. And in this, the CAPE price E10 ratio, we're looking at number 3 basically at this time. And it seems to be just increasing since the financial crisis has gone on the uptrend. Okay. Once again, I don't like that. I don't like how it has gone up so dramatically, and seeing what it has done before, not a good thing. And then you look at the total market cap versus the GDP, and yet another rise coming up from, I would say, after the financial crisis. It has led upwards significantly. And it has actually beat out all but, once again, the tech.com boom. It's actually getting pretty close. And the reason that the tech boom was so important was because the numbers became nothing but thin air, nothing but garbage. It was all a fraud. And it was very clear. There wasn't necessarily anything pushing it into a territory where it should have been. It was all just made up, completely fraudulent numbers. Now we had all the subprime garbage that happened throughout, leading up to 2007, 2008 timeframe. But I would just say that clearly there is an issue which we are heading towards in the exact same direction. Am I saying there's going to be a crash tomorrow? No, I don't know that. But what I'm saying is trying to, wave everybody down, say, the building is on fire. I think everybody should, exit. That's simply what I'm doing. I'm just trying to warn, just trying to tell individuals. If you think there's a few individuals out there, sad individuals out there who think that, there's some sort of nefarious, thought behind what I do here. I don't have any paper investments. I sold the last bit at the end of 2007. So I don't have any stake in the game. I don't want to get in this game. Look how bad it has become. Now, sure, if in March 2009, if I would have put money into the stock market in a basket of different stocks and then sold it today, I would have made a lot of money. But I didn't do that. I sold it prior to that crash, and I've simply been doing, what I call the money GPS strategy. So, if you're making profit, that's excellent. Good. I'm happy. Because, if everybody does well, I'm doing well, my family's going to do well, everyone's going to do well. It's good. It's good to see that. That's not my strategy. Okay? I'm trying to warn people. I'm trying to look at the fundamentals. I'm trying to look at all the technical analysis. I'm trying to piece it all together from all the different sectors. People have all these type of ideas and what's the right thing to do. I take it all. I try to piece it together, try to simplify it, and that's my program. I hope you appreciate it. If you do, please give me a thumbs up. Last but not least, if you found the video informative, I know you will find my books, The Money GPS and Global Economic Collapse, even more informative. This gives you a little breakdown of what they're all about. If you want to check them out, just go over to Amazon. They have a look inside features that will allow you to flip through the pages of the books and see if you like it. Take care.